I am an international partner at Charles Russell Speechlys, and I lead the firm's focus in Asia. I've been a partner at the firm for over 10 years. Prior to arriving in Hong Kong earlier this year, I lived and worked in each of the jurisdictions in which we have offices in the Middle East, so Bahrain, Qatar, and Dubai. In addition to my management responsibilities, I am also the head of real estate and hotels and hospitality across Asia and the Middle East. That's my day job. It absolutely is a priority for us. We have invested further in this market over the last 12 months. In addition to establishing our own Hong Kong LLP at the end of last year, we've also recently moved into brand new offices in 2 Pacific Place, a real statement of intent for us and how our business has developed and grown since we first established a presence here back in 2017. There are so many reasons why Hong Kong is an important market for us, and I'll touch on some of the main ones. At a macro level, Hong Kong is a global financial hub, and we believe it will continue to hold this status going forward. The fact that it forms a key part of the Greater Bay Area will only enhance its position. It's a truism, but Hong Kong's interconnectivity with the whole of mainland China also gives rise to huge potential opportunities from a size and scale perspective. At a more micro firm level, we want to be operating in the key global wealth centres. Our global footprint reflects this, as we have offices in a number of these centres already, such as London, Paris, Zurich, Geneva, Dubai, and obviously Hong Kong. At the heart of what we do in Hong Kong is private client, private wealth work. This drives our strategy here and is something that we as a firm are truly preeminent in. We now have one of the largest private client teams in Hong Kong and have recently been recognised as Band 1 by Chambers High Net Worth 2021. An incredible achievement given our relatively short operating time in this market. Our focus sits naturally with Hong Kong's position as a global wealth centre, along with its connectivity to mainland China. So for example, Hong Kong is Asia's largest cross-border private wealth management centre, second globally to only Switzerland. On average, China is creating a billionaire every week, and there has been a 20% increase in ultra-high net worths in China over the last 3 years. Hong Kong is also being seen by mainland Chinese companies as a preferable alternative to other jurisdictions for listing their companies, which is fueling more IPOs in the local market, further generating capital and of course private wealth here. The pandemic has obviously impacted our business, as well as all businesses, even if we just assess it from an operational perspective. Things like working from home, the increased use of VCs, restrictions on travel, ensuring the continued safety and well-being of our staff, and the list goes on. However, as a firm, we have robustly weathered the COVID-19 storm. In fact, in the last financial year, it was our firm's best ever. All parts of our business played a role in achieving that success, but our continued focus on private client, private wealth work was very important. Essentially, and when COVID-19 became a pandemic, it was clear that our clients were changing their focus from wealth generation to wealth preservation. This obviously created opportunities for us to support our clients through volatile conditions and with their critical objectives around wealth and asset protection, as well as structuring and succession planning. What has been really pleasing is that we have been able to demonstrate that we really are trusted advisors to our clients during these challenging times. This is a very broad question, and it really depends on what part of our private client, private wealth practice we are focusing on. But I would say some generic trends will be the reviewing of existing structures and assessing whether they are fit for purpose. We are certainly seeing an increased appetite to review the governance of family structures and family offices. The rationalisation and potentially simplification of existing asset holding structures is another area of focus. The potential diversification of investments and existing asset portfolios is potentially another trend. And lastly, a continuation of asset protection and succession planning for future generations. All of the above are set to continue to be areas of focus for our clients and are therefore going to keep us busy, probably very busy, over the coming months.